Hello, everybody. Attorney Kevin Pritchett here for the Law Office of Kevin Pritchett Keeping It Real podcast, the podcast dedicated to keeping it real in areas of legal, financial, wealth accumulation, real estate investing, just about any business area we will talk about in this podcast, and we will keep it real. Today, I want to drill down on the 3 tax buckets. I got a huge response asking about tax buckets. What are they? How do I get it into the various tax buckets from the previous podcast? So I'm going to talk about that today. This is podcast number 6, by the way. All right. So you see here the 3 buckets are the tax now bucket, the tax later bucket or tax deferred, tax free, tax never bucket. In the tax now bucket are assets that are taxed right now: mutual funds, stocks, CDs, and savings accounts. Now, let me circle stocks here. A pure stock can also be in the tax deferred, and it can also be in the tax never category. Let me talk about that in a minute. But the tax now bucket, you want to put things in there that you have to have, like emergency money to pay your bills, pay your mortgage, pay your car, just money you need for the oh shit factor of life. And you really can't help it. It's going to be taxed. But you don't want to have the bulk of your wealth in tax now category. That's my point. And here's a sober truth. If you are a W-2 employee, and that's the only wealth accumulation you have, all of your income and potential wealth is in this tax now bucket. That's why people who make a paycheck can't ever get rich. You have to take some of that income and deploy it in these other buckets, and upcoming podcasts will talk about just that, the wealth cycle. So, mutual funds get taxed. Now, mutual funds have a deferred capital gain component to them, just like stocks do. The only time stocks get taxed now, immediately, is for the dividends. So really, this should be a paren. Dividends for stocks are taxed now. Stocks are actually more accurately in the tax deferred and tax never category. Why? Because let's say I use this example. A client came in and she wanted a consultation about how she should get some compensation. She's a very highly paid consultant, makes $200,000 and $250,000 a year, head of a department, and she's up for a big promotion. She wanted to know, should she get her promotion in cash, stock, whatever. And I just ran through the example. I asked her how much of a raise she was likely to get. She said, maybe $20,000, $30,000, something like that at the most. And I told her in her tax bracket, that $20,000 or $30,000 is going to be taxed close to 45%. Whereas if she took the equivalent amount of money in stock, there would be no taxable consequences to that receipt of stock. And as that stock grew in value, this is a publicly traded company she works for, as that stock grew in value, the gain on that stock would at the worst be over here in the tax deferred bucket, but ideally in the tax never bucket. Let's say she never draws on that stock, but she could borrow against the stock if she wanted to and get money from that alone, which is tax free. If she never used that money, she got accumulated wealth that she could use on her balance sheet, use it to get loans, to get business, start a business, or whatever it might be, and then pass it on to her heirs. Her heirs would not pay tax when they receive that stock, and they could continue to ride the accumulation of the value of that stock, theoretically, forever. You see the power, my friends? Either you could take $25,000 and be taxed on it at 45%, or take that $25,000 and put it in the tax deferred or tax never bucket and literally sit on hundreds of thousands or potentially millions of dollars over time. So I hope this example shows the power of accurately analyzing the power of each of these tax buckets. Now, let me talk about a tax trap here in this second bucket, and I'm going to have a whole podcast that's devoted just to this tax deferred area, but let me just quickly hit it now. The government created these 401 IRAs and 401k retirement plans when the reality that companies were no longer going to provide pensions for workers, that workers were on their own. Well, the promise was put money in these tax deferred instruments. You won't have to pay, you'll get a tax deduction, small tax deduction for the amount of money that you are eligible to put in, and then that money will grow tax deferred. Now, and the promise was when you get ready to take that money out in your retirement, you'll be in a much lower tax bracket. And yes, you will have to pay tax when you take the money out, but don't worry because you'll be in a lower tax bracket. Nothing could be further from the truth. Most people, when they get into their retirement age and they have accumulated 401k, they are not in a lower tax bracket because the government requires you at a certain age to take money out of that 401k and IRA, whether you want to or not. So really, this is the government's way of saying we'd much rather get the tax on the accumulated crop rather than just get the tax on the seed. So we'll give you a little bribe of the deduction to put your money in the IRA, 401k. Let it accumulate. That's okay. We'll wait for our cake. But then when we get paid, we'll get paid in tax on a much larger portion. The government will get more tax. You see why it's a tax trap? The objective is rather than putting your retirement savings in a 401k or an IRA, you ideally want to put it in a Roth IRA because money that accumulates in a Roth IRA accumulates tax deferred just like a regular IRA. But after a certain amount of time, you can take that money out and pay no tax. Now, there's no free lunch. There are limits on the amount of money you can put in a Roth, just like there's limits on the amount of money you can put in an IRA every year. And there's income qualifications. You can't make over a certain amount of money and have a Roth. But if you fit in those guidelines, a Roth IRA can be an extraordinarily powerful way to get wealth accumulation in the tax never bucket. And it's also possible to do real estate investing from a self-directed Roth IRA or a self-directed regular IRA. Now, let me just make sure you understand the power of this. If you can use the leverage of real estate in an environment where you never have to pay tax on the gain from that real estate, you have hit not just a home run, but a grand slam. My friends, I could go on and on and on. There are strategies with annuities you can use to be in the tax deferred and essentially in a tax never bucket. So many strategies depending and so many different tools and which strategy and which tool depends on your own individual situation. If you've got questions about how you'd like to or what your particular situation is and how you can get in these desirable tax environments, click the link down below, sign up for a consultation. We will review your situation and let you know how you can take advantage of these various strategies. We can build plans for you. Okay, my friends, that's all for today's Keeping It Real podcast. Hope you got some value. If you did, pass this podcast along to other people who you think might need the info. Okay, till next time, Kevin Pritchett signing out.